Our first session up is our State of Digital, and let's launch right into that. My partners and I are going to cover markets, data and identity, CTV, commerce media, audio, mobile app, and shiny new things. But first, a preamble. It seems like, we opened our 2018 Digital Media Summit with the concept of change. It seemed like there was this sort of tremendous amounts of change in the industry that was taking place in the year 2018. Well, 2019, we called it more change. And then in 2021, when we did our virtual, we were breaking the change meter, we thought, until, of course, 2022's answer to that is hold my beer, because it seems like we are now in a state of constant change in this sector. Last year, what we called a perfect storm was the combination of very positive industry developments, very positive and demand producing, enhancing macro environments with cheap money and lots of stimulus, and positive markets, all-time highs, record activity in financings, M&A, you name it. So we called that a perfect storm. Of course, fast forward 1 year, and we've got all kinds of sort of, reversions from this. Most of them, you'll note, are exogenous, right? Most of them are macro environment exogenous impacts, largely from government policy. Yes, we do need to deal with data deprecation, and there's both positives and negatives, as we'll be discussing, but these macro exogenous impacts are affecting the industry. Now look, the path is never easy. It's never a straight line to success, but this industry has been through challenges before, and it's got the kind of agility and resiliency to succeed regardless, and we will get past these existing challenges, because we're convinced that, Rashad Tabakawala, advertising is here to stay. Rashad Tabakawala famously analogized agencies to cockroaches. He could have just as easily been talking about advertising itself. It is, ladies and gentlemen, here to stay. So now to talk about markets, Mark Greenbaum.
Yeah, so I'm going to touch on markets a little bit here. I'm almost afraid to look. I mean, if you read out there in the press, you think it's Armageddon, right? The worst of 2000 and 2008, not just speculative tech companies pulling back, but also, these macro trends coming in, inflation, talk of recession, interest rates, war, all those sorts of things. Let's take a look here. Ouch, yes, it was a rough few months. In fact, actually all of the subsectors we track are down meaningfully, especially MarTech, AdTech, and content, down almost 50% from where they were just 6 months ago. But let's pull back a bit. I mean, do you all remember early 2020, pre-pandemic? I know it feels like a lifetime ago, but I kind of recall being relatively bullish about sector trends back then. If you compare where we are now to where we were then, look, almost every subsector is actually up since then, with AdTech being up meaningfully, up over 100%. And the public markets, IPOs were kind of on fire. In the last 2 years, we doubled the number of public companies in the sector to almost 50 now. And admittedly, while this year we have seen no new issuance, understandable given the market conditions, the pipeline for IPOs remains robust, with about a dozen companies that have either filed or rumored to be contemplating near-term IPOs. So if we look at that public company ecosystem, these are the ETFs that we track at LUMA, LUMA A, AdTech, LUMA M for MarTech. Where we were back pre-pandemic, you had about a dozen companies in each, a little over $100 billion of market cap, and about twice the multiples and twice the market cap in MarTech than what you saw in AdTech. So where did we get to? This is about a year ago, somewhere near the peak. $450 billion of total market cap spread out about 35 different companies, but look at those multiples into the teens. And importantly, you finally saw public company investors start to appreciate ad tech business models, whether it's recurring, reoccurring revenue natures, variable pricing, or that blend of profitability and growth. We call it like the rule of 40 measures. You saw those multiples appreciate, actually slightly eclipse what you saw in MarTech near the peaks. And so where did we land now? Not just looking at price, but looking at multiples. You still got almost $250 billion of market cap spread across 50 companies in the ecosystem. And look at those multiples. Ad tech is actually at a premium to where it was pre-pandemic. And while MarTech is slightly off that level, I think it's pretty far away from the doom and gloom you kind of hear out there in the market. We're talking about public markets. Wanted to touch for a second about SPAC activity. No surprise there, SPAC new issuance have kind of fallen off a cliff. I think the message to take away here, though, is you still got over 600 SPACs racing against the clock trying to find a deal. So while I think public markets will be more scrutinizing than they have in the past, for quality companies, I do think SPACs could be a way to accelerate a path to public markets. Okay, let's talk about M&A. Terry called this a year ago. We had the perfect storm, hold on for the mother of all M&A markets. And sure enough, a boom we had. Record levels of M&A kind of across all the categories. We saw a ton of strategic deal making, in data, in CTV, commerce, media, audio, of course, mobile app. The other thing that was driving all the deal activity, more buyers. You saw private equity come into the space in a very meaningful way. We're going to talk about that more in this afternoon's panel, so please stick around for that. And then how about all those new public companies? They did not just sit on the sidelines. A number of them got active. So half a dozen used that newly minted currency, accounting for another 16 strategic deals. So a ton of M&A happening. On the private company side, just taking a snapshot of big financings. These are the over $100 million type raises. Used to be relatively rare. We saw 28 of them a couple of years ago. That almost tripled, $75–100 million raises in the last year. So yeah, the private markets were also flush with capital. So where do we go from here? It has been a roaring couple of years. You're going to hear a lot today. We still believe most of the trends driving consolidation and financing space remain intact, but you'd be blind not to see we're flying through a fair amount of uncertainty. We've even seen, in deals we're working on now, a number that have either hit pause or even kind of stepped aside while we're working through the current dislocations and valuations in the market. So we know uncertainty does not help deal making. So I think near term, we're going to have some headwinds, big question mark. I can't tell you whether that's going to last another 2 weeks or 2 quarters or 2 years, but that's going to be the dynamic. But it won't surprise, I think, anybody in this audience to hear, I think, LUMA remains bullish long term for the sector. Great. So those are the markets. I'm going to welcome my partner, Brian Anderson, up to talk data and identity.
Thank you, Mark. So first of all, it's great to see everybody in the audience, all your friendly faces. It's been way too long. So we wanted to start this, the trends section with identity, because identity is so core to basically everything we're going to be talking about up here on the stage. And to state the obvious, without identity, there is no right message getting to, reaching the right person. But over the last few years, we have seen a lot of challenges. So an update on the privacy regulation side, we've seen 2 new state laws being enacted with more pending. On the platform data restriction side, probably the most recent notable change was Android deprecating the Google advertising ID that's being replaced by the privacy sandbox for Android. That's really being defined and finalized over the next couple of years. But with all those changes, it's joining Google Chrome cookie deprecation coming up, the IDFA moving to opt-in, with the net effect of all this being less identifiers that can be utilized. So that obviously creates challenges. So yes, with the one-to-one targeting on the open web and in the mobile app environment. But even the walled gardens are not immune to this. We've seen how advertisers that have relied on Facebook for customer acquisition, the customer acquisition costs have gone up significantly. So you've seen a lot of D2C brands in particular being affected by that. And then measurement in general gets more difficult without the identifiers, with certain capabilities like multi-touch attribution just breaking without identifiers. But where there are challenges, the nice thing we've seen is there's a lot of opportunities. So we've seen a resurgence of contextual advertising and creative technologies. And notably, we've really seen a spotlight being focused on first-party data. So enterprises gathering, managing, and utilizing consented first-party data. So all this has really driven really nice growth and opportunities in a number of areas: CDPs, new identifiers, identity graphs, incrementality measurement, data clean rooms, and commerce media. As far as CDPs, if you look at the space, it's seen really nice, consistent growth of revenues, employees, funding, over the past few years. And now you have a half a dozen companies in this category alone that are at the unicorn or a couple at near unicorn levels. And for brands, what's really required is to have a comprehensive identity strategy. So yes, gathering and utilizing those first-party identifiers, but also making sure they understand what are they going to do where there is no identifier available. We've also seen a proliferation of a bunch of new identifiers and identity solutions, in the market. And what we don't expect is to have, a winner out of all this, one being the one identity to rule them all. What we do expect and what we're seeing is these identifiers and identity solutions working together. So classic example, LiveRamp ATS and Unified ID working together. And so we expect that to occur, plus identity graphs, that traditionally have been used to tie together mobile IDs and cookies. They're also linking all these identifiers, so really becoming an Uber kind of identity solution. We've also seen the rise of data clean rooms. So, with enterprises, focused on, gathering, managing their first-party data, they want to utilize that data without that data leaking. So that's exactly what these technologies enable. So we've seen, years ago, Google launch Ads Data Hub, which I believe was the first clean room in the market. But what has been really notable is the last few years where the independent parties, have come in. So you have folks like Habu and InfoSum, both here in the room. They're enabling enterprises to really create, very innovative data sharing and data activation capabilities while protecting that data. So, we're very bullish on this category. We're not the only ones. A recent survey has shown that the majority of enterprises expect to invest further in this category. Terry?
And one logo missing from there, Optable, also in the room, data clean room. So thanks, Brian. So here's an interesting sort of way to think about, the implications of this data deprecation that Brian spoke of. So for a long time, the digital media ecosystem was thought of as a bifurcated world of walled gardens and open web. And look, there's a lot going on in these realms. You've got, Google is under focus, antitrust focus from a variety of jurisdictions. As Brian mentioned, Facebook is having performance challenges and, of course, a corresponding stock price decline. Twitter is in this bizarre ownership crisis with Elon Musk that gets tweeted about with emojis on a daily basis, which is bizarre. And yet we're seeing the rise of a newcomer, TikTok, which is rapidly taking share of time, attention, and now ad dollars. We'll see whether their Chinese ownership will have implications going forward. Meanwhile, in the open web, some challenges. As Brian mentioned, the data deprecation is creating challenges, and we've seen real, the digital native publishers are really having a tough time in terms of stock price or having to sell their companies, and some have even questioned the fate of independent journalism. However, we believe that the data signal loss that Brian referenced earlier is actually sort of re-architecting the ecosystem. We're going from a bifurcation to a trifurcation where you've got essentially hedged gardens. Now these hedged gardens, which I believe can be referred to also as content fortresses, by Eric Seufert, are basically companies with large pools of first third-party consumer data that run their O&O business, but it's not big enough on their own. So hedges are not as tall as walls, and they're more permeable. So often they have to go off network. And you tend to find these in CTV, commerce media, audio, and gaming. And what's fascinating is to see some of the strategies that they're deploying. Horizontal strategies where they're trying to combine supply with demand to create a whole stack ecosystem, either through M&A or through their own internal efforts, and vertical integration, where you're seeing companies going in one direction or the other, combining O&O and platform capabilities. So let's talk about CTV in particular. So we seem to be maturing surprisingly suddenly in the subscription space at just over 4.5 subscriptions. What's been fascinating by this, it's seemingly sudden, but it was kind of predictable, and we have been talking about the eventual sort of end of the road of growth for SVOD. And look, just in April, right, we saw CNN Plus shutter just after 2 Scaramucci's. So there's definitely challenges there. And then very importantly, Disney Plus and HBO announced ad-supported platforms in variants to their original subscription model. Even the king of subscriptions, Netflix, which at one point said they would never get into the advertising business just 2 years ago, all of a sudden now has announced that here they come, and maybe as soon as the end of this year, they will be selling ads. And of course, this has led to a significant growth in the ad spend for the CTV sector, but that's had to be adjusted. eMarketer had to increase in the last 2 years their projections as to revenue for CTV ad spend. And if Netflix gets into the ad business, as they have signaled, expect further upward revisions to that number. This year, over $20 billion. With a large portion of that coming, or a growing portion, coming from FAST, or free advertising supported television. When these are like Amazon's Freevee, Pluto, Tubi, and all the OEM TV manufacturers that are basically running linear-like networks only over addressable CTV. In fact, in a survey, that is the ad model of most preference to US TV viewers. So I think you're going to continue to see ad-supported in both FAST as well as AVOD. And all of that is leading to a substantially growing Convergent TV ecosystem of $167 billion this year. And yes, while the OTT and digital video are the fastest growing subsegments of Convergent TV, let's recognize that linear is a massive portion, and it's not shrinking. Okay, it's growing slightly. So we have long said that linear TV will be the key to scaled audiences in a Convergent TV ecosystem for quite some period of time. We know the trend line is away from linear and towards streaming, but it's going to happen at a pace such that it's going to be important to understand linear. And linear is really driven by live TV, and live is driven by sports, and sports is dominated by football. So all you have to do to understand where linear TV is going is to look at the sports rights contracts of the NFL. Amazon has now bought the rights to Thursday Night Football exclusively, other than local broadcast, on Prime. And we are all watching for the Sunday Ticket, the big Sunday programming contracts up next year, to see whether a company like Amazon or Apple or Google or someone else might buy those packages. That would change linear forever. Meanwhile, TV measurement is going through substantial changes. Nielsen sort of ruled the roost here for a long period of time. That has now proliferated to a variety of challengers. many of which have either done major financings or M&A transactions to take advantage of the zeitgeist of new competition in TV measurement, now that addressability is paramount, and we want to move beyond the survey. In fact, this was largely catalyzed by the VAB last summer and then accelerated by NBC's RFP process. And NBC Universal even put out a graphic of players in the TV measurement space. Imagine that, a graphic that categorizes logos on a map. Where would they have gotten that idea? But tremendous fragmentation and tremendous opportunity. A couple of interesting developments in CTV beyond just the sort of transfer of brand advertising to that channel is performance advertisers have found the TV channel. These are folks that, as alluded earlier, are having a tough time, converting their LTV to CAC ratios from Facebook, and so they're looking, direct-to-consumer and other performance advertisers are looking to television, and a number of platforms, including Mountain, Tatari, and TV Scientific, have launched platforms to take advantage of that. Also interesting are the intersection of gaming and television. We've noticed that Netflix has invested in gaming studios, and other companies have basically entered into transactions or launched products that effectively treat in-game advertising as CTV inventory. This will be a fascinating space to watch.
Thanks, Terry. So next up, we're going to cover the commerce media sector. So this is an area that's gotten a ton of attention over the last few years. We've really started covering it back in 2021. And it's driven by a couple things. I mean, obviously, 2 years ago, we all were sent indoors, started buying a lot more online, in-store completely dropped. And so you had all these retailers start to realize they need to focus on this sector. And this is where they're selling digital advertising, both on their site and using their data to sell off-site. But what's been shocking is just the sheer size of this ecosystem. So just recently, eMarketer put out these numbers finally, and this year alone, the retail media sector, just retail media, is expected to be $40 billion in ad spend and going to 60 in a couple of years. Some even have it at going to 100 billion by 2025. Just to put that in context, when we just talked about CTV, we've been talking about it for years, the streaming TV ecosystem is 20 billion. So this is 2 times that just in retail media. And Amazon is very clearly the poster child for this sector. They've been driving a huge business for years, but it really came out recently exactly how large that was. Finally in 2021, or at the end of 2021, they had to disclose their numbers, and they've got a whopping $31 billion advertising ecosystem. So that means they are larger than YouTube and very clearly the third leg of the digital triopoly with Google and Facebook. What's been interesting to watch is how they are prompting others to jump into the sector. And we've noticed that it's really hitting on both ends of the spectrum of sort of the emotional decisions around investments, which are greed and fear. So on the greed side, it's pretty easy to see. For any retailer with a large digital presence, this is a scaled, high margin revenue opportunity. It takes little cost, and frankly, these guys are not used to being able to get high margins, so it's very attractive. It leverages their existing assets. So for years, retailers have been collecting first-party data. They've been focused on personalization already, and this only further develops that. And in the best cases, it actually improves the customer experience. So, all the way through, a good thing. But then there's the fear side of things. So this is an analysis that Marketplace Pulse put out, and it tracks the top line here is Amazon's retail profitability with their advertising business. And the blue line is their profitability without their advertising business. And as you can see, over the last few years, that gap has been spreading dramatically. And in fact, the last 2 quarters, Amazon's retail business would have lost $10 billion a quarter had it not been for their advertising ecosystem. So that means any other retailer who is competing against them in the digital landscape has to say, if I'm going to compete with them and they can't make it profitable, how am I going to do that without an advertising business? What's very exciting too is this evolution that's happening in retail media. So those points were all on retail, but what we're seeing is this changing to commerce media. And I thought eMarketer in a webinar recently with Criteo did a great job depicting this. So Retail media really started on-site for the retailers, search intent-based advertising, so very bottom of the funnel. It's expanded to go upper funnel, display, video ads, even adding in in-store connections. But where it gets very interesting is this expansion, where you start to change the industry. So it's not just retailers, but anyone touching the commerce channel. And I would also add the sort of consumer touch points. It's not just retailer sites, it's off-prem, it's social, it's live streaming, commerce, on and on. There are more and more touch points where the commerce and media intersection is beginning to touch, and all being powered by data. And this is clearly why Eric Seufert has coined that everyone's an ad network, and we are seeing this proliferate across the board, a wide variety of categories. You've got the digital first players, mass merchandise retailers, category specific. Then you've got other intermediaries like delivery, travel, consumer entertainment, and even finance and payment players getting in. Just yesterday, it was announced that Marriott is actually starting in a commerce media or an ad network alongside Yahoo. So it's very clear why the retailers and the platforms want to get involved. Huge business opportunity. There is a question of what does this mean for brands? Why is so much spend directed to this channel? Well, it's because the commerce media is at the center of these fundamental sector trends. So we just talked about data and identity, the need for it in this ecosystem, and clearly these players have a lot of that and are able to bring it to bear. The other aspect is they're able to actually drive performance. And so when Facebook and others lose that performance, especially for things like direct-to-consumer brands, commerce media is jumping in to fill that void and therefore drive growth, both for their platforms and for all of those brands that are seeking that growth. One thing we've noticed as we've dug into this is how much what's happening in commerce media actually echoes what we saw in search and social. So Google and Facebook, clearly the dominant players here, the digital duopoly, and there's three things that they have. They've got scaled consumers, robust first-party data, and automated performance. That means they can both have a simple onboard for customers to come to their platform, and they're able to tie their ad spend back to actual results. What that meant for them is they have millions of advertisers all spending to the efficient frontier. So they're not reliant on specific large budgets, but rather the millions of small budgets. And when they turn advertising into a cost of goods sold, those advertisers are going to continue to spend as long as they see results. And that is particularly important in a time like this. As you're talking about potential recession, the more and more that advertising shifts from discretionary to cost of goods sold mean that people will be able to continue to spend. And this is exactly what the commerce media sector has. They've got scale, they've got first-party data, and they're building automated performance. That is the part that is certainly on the rise. But the other crucial aspect is that they have closed-loop attribution. And so it's search and social plus. And so with closed-loop attribution, particularly in this data ecosystem, means they don't need to rely on other people's data to close that attribution gap. That said, the ecosystem is taking a different approach. So while Amazon has clearly followed the Google and Facebook approach of walled garden, others are taking more of a hedged approach. And it's just really a matter of who they are, right? Amazon has a scaled global audience. They have millions of advertisers and merchants, either through their first-party or third-party marketplace, and they have a tech-centric core business. So they are built to be able to do this themselves. And they're continuing to expand and look for new ways to garner data. Others, though, don't have that, right? They are traditional retailers moving into this space. And while they have robust technology now, they're still looking for ways to move off-prem, do other things. And that means they have to be a little bit more open to using their data. It's going to be secure, but they're going to leverage third parties. This will allow them to extend their reach, onboard and connect data, measure better, and frankly, just move faster because there is such a big opportunity they need to be moving quickly. And they also have to do this because, like I said, Amazon's not sitting still. Just the other week, Amazon announced a new initiative called Buy with Prime, whereby on sites off of Amazon, you now can buy with your Prime membership, leverage their logistics. And this is tied initially to driving logistics, making it easier for consumers. But as we all know, what does that mean? It means more consumer data, more touch points that they can leverage into their advertising ecosystem. So with this hedge garden approach to the market, it means that there's been a robust third-party tech ecosystem built around this. And At LUMA, when we see a robust third-party tech ecosystem developed, there's only one thing to do, and that is to create a LUMAscape for it. So we are very pleased to announce our commerce media LUMAscape. The goal here is to look at sort of that connection between media and commerce. It's not just with retailers, but it's search and social, the publisher platforms, live streaming, et cetera, at the top, so sort of the media execution at the top, and the bottom is more of the infrastructure, data analytics, the CDPs, the commerce platforms. Anytime we launch a LUMAscape, there are two fundamental things we know. One, they're wrong, and two, they're evolving. So, we welcome any criticism, any thoughts, any additions. We will be continuing to evolve this over time, and frankly, we'll need to because this ecosystem keeps changing. So next, I'm going to touch on the audio ecosystem. Another area that has robust third-party technology coming to it has been growing over time. We put this LUMAscape out a couple of years ago. Overall, the digital audio ecosystem, it's growing at a decent pace. It's about $6 billion in 2022. But where a lot of the attention is on the podcasting side of things. So in 2021, podcasting grew 72%, and about 4.5 times the rest of the digital audio ecosystem. What's been very interesting to watch is the inflection that's happening in podcasting advertising. So this was from a couple years ago. Expected to be 1.5 billion this year, still under 2 in a couple of years. But just last week, the IAB put out new numbers where they've completely doubled the forecast. So we're expecting to be over $2 billion this year and above 4 by 2024. So that means there's really more of a robust ecosystem here. There's more opportunities to get involved, especially across the omni-channel landscape. What's driving this is a few things. First is consumer growth. So consumers now, there's 125 million US consumers use podcasting on a monthly basis, and it continues to go up. The second is ad delivery, and this is very important. In the last 2 years, we've completely flipped from baked-in ads where when the episode is made, the ad is coming with it, to dynamically inserted ads. And what that means is, one, there's a lot more addressability in this channel, but two, it is far more efficient for advertisers to get, and more advertisers to get into this. And that is exactly what we're seeing, which is this expanding advertiser universe. The other week, IAB came out with their report, and the largest category of podcast advertisers was actually one called Other, which was a collection of smaller advertising buckets having more and more advertisers. And just like we talked about with commerce and search and social, that is where things get interesting. That is where the market can really start to expand. So what this is creating is a bit of an audio platform wars. You've got the digital first guys on one side who are fully focused on the sector. They've done a ton around creators and content. They've started investing in monetization. And then you've got the digital giants who really look at it from a different lens, right? This is one part of a much wider media strategy. They also are in a very unique position of controlling the operating system and the devices that these are on, and importantly, the voice platforms, which if audio moves towards interactivity, voice is a crucial component of that. And similar to what we've seen in other sectors, this one has seen a ton of vertical and horizontal M&A. There's a little bit of horizontal, but a lot of the focus is on vertical. As you've seen, all these players try to access content and monetization capabilities in order to garner consumers to their platform and then monetize them. And importantly, Spotify just this year really went the full stack and actually acquired some of the leading players in podcast attribution. So they've got everything from the distribution, the content, the monetization, and down to measurement and attribution. We expect to see more and more plays here as everyone looks to fill out their stack and just a robust ecosystem going forward. With that, I'll turn it over to Dick to cover mobile app.
Thanks, Connor. Great to see everyone in person again. It's been a crazy couple of years in the world and in the mobile space. Continues to be a great place to be in the world. Scaled spend in the space, nice healthy TAM and continued growth. One interesting thing to call out that's a little different than last time we were together in person is the growth of the non-game sector. It's become a pretty interesting business, outpacing the game space, which still dominates the space with more than 60% of activity, but a lot of folks in the space are now focusing on non-gaming to try and help advertisers and publishers drive continued growth here as well. We've talked for a long time about what a great vehicle phones are for advertisers to reach their desired audience. I think we have to caveat that now. It's for opt-in users. But even with diminished signal in the space, just look at the numbers. The number of people, everyone has a phone. They spend a lot of time on it. We just talked about the dollars in the space. So it remains the place to be. And interestingly, last time we got together in person, we didn't talk about signal loss or signal degradation in the mobile app world. It was a selling point for mobile apps that they didn't rely on cookies and weren't subject to cookie deprecation. 2 years ago, we couldn't have DMS, so we had to do this from a work-from-home webinar, but Eric Seifert and I started to talk about, what would be the potential implications of this kind of arcane, at the time, dynamic of limit ad tracking, LAT on device with phones identified as zeroed out, and what could happen if that changed, impacts on the ecosystem at a time when Apple was starting to pay more attention to their ads business, and what it could potentially do for Apple's business given their relatively low market share in the advertising space. By the way, Eric's moderating a discussion on this topic later today with a bunch of great panelists, so you should check that out if you want. And he just launched or announced publicly a venture fund, so if you're one of the people that's dreading going back to the office and starting something new, hit him up for some seed capital. So obviously, a couple of months after that conversation, Apple launched their app tracking transparency framework. It has dominated the headlines in my industry news feed. Very, very big change in Facebook saying it's going to take $10 billion out of their revenue forecast for this year. A number of other publishers and advertisers suffering from some headwinds with diminished targeting and measurement capabilities. It's not all bad, though. Some of these mobile-specific guys have benefited from the performance degradation in Facebook specifically and have had really good results over the last couple of years and continue to grow and have nice scaled profitable businesses. It's obviously benefited Apple quite a bit as well. I think Business Insider just reported that their ad business estimates for it were up over 250% last year. It's becoming big. They have continued a lot of headroom to grow in the space, given expansion of search ads into Apple ads and in their news, and as they continue to invest in streaming, et cetera, lots of room to grow there. It's been something that we've benefited from as well, with a lot of well-capitalized companies investing in the space, a lot of M&A activity, which we expect to continue to see regardless of current volatility in the markets. One to call out here is Unity. They've done a ton of acquisitions, not a lot in the ad space, but given their recent hiccup on the ad side and their earnings announcement and increased conversation around the advertising business, we'll see if they continue to invest more. Beyond that, there's a number of other players that have even bigger market caps that could benefit from having an in-app leader on board. So I think we'll continue to see some more activity in the space. And not to end on a downer, but we do have to recognize that it's a fluid market. There will be continued changes to navigate through. Apple has their next WWDC in 3 weeks. We'll see if they extend their global VPN to mask IP addresses and hinder measurement through probabilistic methods. Google has announced Privacy Sandbox coming into Android. I think that's going to be less disruptive, given that they're doing it in consultation with the industry, and we'll do it in a more measured fashion. But overall message is, regardless of these changes, mobile's still a great place to be. There's tons of smart people in the space that are working on contextual targeting, creative optimization, modeling for measurement, and we'll continue to benefit from all of this going forward. So I'll let Terry take over and take you into the metaverse.
All right. Thank you, Dick. So just a quick note on what we describe as shiny new things. The marketing sector loves shiny new things, right? The latest. And the technology sector is enamored with the notions of sort of Web3, NFTs, and the metaverse. As M&A advisors, though, we have to take a little bit more of a skeptical lens on this, or call it a practical lens on this. Can these initiatives and opportunities create, meaningful business models in a reasonable, period of time? With Web3, look, we think there's tremendous opportunities for distributed networks and tokenization. There's a lot of use cases for that. We are concerned that we don't, the decentralized, doesn't become just re-centralized with new companies. So we're mindful of that. And in particular, the applications to media and marketing. We're really interested in looking for tangible use cases. NFTs make a ton of sense as a media property, right? Trying to recreate physical scarcity in a digital world. So that makes perfect sense. Time will tell as to how much demand is going to follow the initial flurry of interest around their introductions. And we note that, volume is off materially, 90% in NFTs since the peak last fall. Perhaps where we're more skeptical is the metaverse. Now, beyond what we would call the native applications of gaming and entertainment, that makes perfect sense, and we're quite certain that 3D models the technology will improve, and that'll be immersive. But the notion that we're all going to be spending a significant amount of time in meetings and like that in the metaverse, yeah, we'll pass on that for now. And by the way, maybe Meta is too, after a quarterly loss of $3 billion in this initiative. There are rumors that they're going to be scaling back their efforts as well. So again, pragmatic, skeptical, want to lean in and look, there's enough smart people in this space focused on it that there's got to be a pony in there somewhere, we're convinced. Great. Well, so that is our State of Digital 2022. And now we're going to launch into our firesides.